Right, for those of you who've come upon the forum and are not familiar with the geography of what we're trying to do, the final one of 4 sessions in the PIF Management Forum is about navigating growth, strategies for emerging asset managers in the Saudi capital market. We've been putting forward building blocks so far, so please come and join me on the platform. As I say, we're going to be talking for about 30 minutes. Then there'll be a ceremony here as well. So we'll keep going until just after 1 o'clock. Very much in the spirit of conversation as much as anything else. Let me tell you who I'm joined by. Mohammed Alnahash, who's CEO of Portfolios Investment Company. Welcome. Aziz Alnaim, welcome. Who is CFA, Managing Director, Maya Capital. Fadi AlSaid, Senior Director and Head of Investment Management Department at PIF, and also Sohaib Jamjoom, who's co-founder and co-CIO of Isometry Capital. Have I pronounced that correctly?
Absolutely.
Thank you very much. Navigating growth. It's a repeat of the word we had in the last session. Navigating suggests there's still a bit of work to be done on the sat-nav, as I put it, on the charts. What's your view, Mohammed?
I think growth opportunities really are massive in the country and the region. So if you look at, for us, regulation have presented really great opportunities for emerging managers like us in the country. 10 years ago, to establish a company with our size and boutique asset management would really require significant capital to put in place initially. And 8 years ago, regulations have evolved, reducing the capital requirement and allowing investment or professionals who are passionate about investment management and have entrepreneurial skills to establish investment management firms and serve the clients with less capital, initial capital. So I believe this creates a lot of opportunities for talents in the market and to exploit the market opportunities around us.
Fadi, let me come to you immediately if I can. From your perspective, what are the most effective investment strategies?
Well, I wouldn't jump directly to the most effective strategies before just taking a step back and just understanding the landscape of asset management industry in Saudi, because it's very important.
Remember, we've been talking about this since 10 o'clock.
No, I know what you're talking about, that, but I think it's important to understand who are you competing against as an emerging manager and how you need to position yourself to add value to the industry. Because the last thing you want to do is you want to actually take advantage of your size and your offering and your specialization in adding value and actually carving out a niche for you. If you look at the asset management industry in Saudi now, it's dominated by large-sized asset managers. It's dominated by capital, by bank-led asset management. That means because of your size, because of your infrastructure, you focus on basically high-capacity strategies that can be managed in size. So what that gives, I think, and I'm talking now to a lot of like well-known emerging managers, that I would like to maybe name them like owner-led managers or partner-led managers. The idea is a lot of these managers left these maybe original kind of asset management firms and because they had a niche or because they had a kind of an investment philosophy that they wanted to focus on. So what helps here is maybe just ensuring that this investment philosophy, this niche, is actually focused on, and using the fact that you have a nimble or lean team in order to create a strategy that cannot be, for commercial reasons and for business reasons, cannot be managed or scaled up by the normal kind of the big asset managers. And this is where we as PIF are very interested in that, because we believe we are very focused on helping and trying to actually cooperate with these managers to create all these kind of what you call in a normal business, the full supply chain, to give these kind of managers ability to explore opportunities that in a normal sense will not be explored or invested by big asset managers due to capacity constraints or capacity size. So I think this is part of the development of the market. These guys will be able to look at small caps, micro caps, Numu markets. They will be able to carve out strategies that maybe a normal long-only strategy that's seeking to manage a 2-3 billion strategy will not be able to do. And this is what we're excited about, and this is where we believe the real added value happens, and the real kind of carving out of kind of specialty in the market, like what you see in other markets. And that's why we are very keen, and we have a special program, although if you look at the numbers, maybe it does not move the needle in the sense of AUMs, but we believe in the long-term seeds of actually these are what we believe is the future big asset management companies that will have this specialty expertise and really the added value we thrive to achieve in the capital market.
Let me just...
So I hope this angle was not covered since 10 o'clock.
But what I want to do is emphasize what I said 2.5 hours ago, looking for the alpha in the fast-moving environment here. Let me come to Suhaib, if I may, because you said something interesting in our pre-talk a few days ago, that there's not enough developed products at the moment. And you're finding as the Chief Investment Officer that that's a real challenge.
No, it's a real opportunity, I would say.
But it's also a challenge.
It is a challenge to have the required infrastructure, the required skill sets, to have the track record, to have a complex operational setup, right, to cater to these new services. But in a market where there's a lot of large liquid beta strategies, oftentimes it makes sense for new managers to venture into uncrowded strategies, where basically the fees aren't commoditized.
How do you turn that opportunity into something which is securable and achievable?
So everything at the end of the day, when it comes to investment, is driven by performance and risk management. You consistently need to generate outperformance, good numbers with great risk, and growth and everything else will take care of itself.
But you said something very granular and very specific, very practical. A good track record as an investor is not enough. There's got to be a good back office.
Yes.
What did you mean by that?
The regulatory and allocators requirements today to allocate when it comes to tech infrastructure is costly and massively higher than it used to be 10, 15 years ago. I always say the age of a one-man show or a lone genius is over. No matter how good are you of an investor, sitting behind your Bloomberg, pulling numbers, you're not going to raise capital. No institution will underwrite your risk. And therefore, you need a proper middle office, proper back office, operations, infrastructure. And that's also the biggest challenge for all the emerging managers. Because the cost, and it's always an opportunity to balance of under-investing or sacrificing your pay as a manager. And our view is always over-invest, pay yourself last. When it works out, you will get basically paid.
Aziz, let me come to you. You said something very intriguing when we were talking about this a few days ago, the rise of passive investing. What do you mean by that?
Well, we've seen it everywhere around the world, and it's happening here. And if you can see it,
What's the impact on the market?
has several things. The first thing that it does is that it makes alpha harder to generate, I think, because the weaker managers leave the market. The retail investors leave the market. And so only the strong managers survive, which means now you're competing. The other person on the other side of a trade is actually well-informed, smart, and hardworking, which means that your job as a manager becomes harder as time goes by, not easier. Basically, the dumb money leaves, and you end up with a smarter and smarter pool of money looking at every opportunity.
So what's the implication of this?
Well, there are several implications, I think, to it. One, your process needs to be different. So what we've seen for the longest time in Saudi, and in many places around the world, and you've seen it back to your point about kind of the bank-owned capital firms, is they all do the same things. The turnover is so high that it can never actually be authentic and have its own identity. And so you're never going to outperform if you're doing the same thing that everyone else is doing. And so to some of the stuff that Suhaib and Fadi said, you need to go into a niche, you need to be differentiated in order to generate alpha. You cannot generate alpha just by being a bit faster or a bit smarter. It actually has to be very different. Your portfolio has to look different. So All of these things have to come together in order for you to actually outperform.
Fadi, you're nodding. Are you agreeing with?
Definitely. This is exactly the point we're saying, and that's why maybe, and this is what, if you look at the performance of a lot of asset management, the asset managers, it was very highly correlated. What we're seeing right now is also what's helping is also the diversity of the market, maybe the new sectors, and for the first time we're seeing the correlation even dropping between some sectors and some companies, and even in terms of on the market cap scale. But what I'm saying is there are opportunities and there are a lot of alpha that can be. It's becoming very tough to generate alpha maybe on the large caps. It's becoming more efficient. Passive flows are coming, so the valuation gaps are becoming very hard to take advantage of. While on the maybe lower market cap spectrum, where you have the specialization, where maybe you have the activist style, where you have the kind of involvement with the companies, the actual, I would call the statistically significant alpha, where it's driven by the manager's action, or it is driven by the manager's philosophy or process that is differentiated from the beta of the market. And this is where we're seeing the small managers have an advantage. And this is where we have these discussions. We actually are very, very cooperative with them in terms of even structuring or designing these strategies. So I totally agree with that, of course.
Can I add something to it, if you allow me? I think the other thing is when you have partner-owned asset management firms who are invested in not only just the bonus at the end of the year, you end up with two things. One, strategies that are different because they have permission to be different, but also strategies that are authentic to the team and not doing something that someone up the chain in a big organization told them to do.
But we need to keep being granular here. Mohammed, again, going back to our discussion about inefficiencies that there are in the system, about regulatory changes, about difference in compliance departments between the corporate sector and the investors. Help everyone understand where you see this and why it's a drag on the system.
Yeah, sure. Because change in regulations could be an opportunity, as I mentioned earlier, but also sometimes changes can increase the operational cost in financial or asset managers. But more importantly, it could derail the management focus if these changes are neglected or poorly managed. So what we have done about this is that we have, first of all, the ecosystem around the emerging managers is improving rapidly. So we have collaborated with we outsource compliance with a firm that is well experienced in the asset management and help us to mitigate any compliance complexity. We also have added another layer of internal compliance to have an oversight over the investment compliance. In addition to this, we have invested in systems. So we have invested even at the early stage of our firm to systematically manage any compliance breaches, etc. And I believe having this approach, having such approach, I believe it could help us be adaptable and compliant and focus on growth.
Did you have a problem which meant you had to do that on compliance?
No, I think that's a natural evolution of starting at a small scale and then grow up rapidly. These things are important because if they're left as is, it could really distract the focus of the investment team from really generating returns for investors to more dealing with any regulatory changes.
We've had to raise talent in many of the sessions so far, but what's your view, particularly the competitiveness, the bidding that's going on?
It's costly. You always need to hire the best employees for
But it's a practical problem, is it?
It is a practical problem from our side, absolutely. There is a limited amount of extremely talented people trading public equities or managing risk or implementing quant strategies. And the talent war or competition is spiking all the prices for everyone. And we're bearing the cost, obviously.
How can that be addressed?
Well, the bigger will get bigger. So the bigger you are, the more resources you can have. I think people can think about an equity-owned distribution, an employee-owned company, alignment of incentives. And one needs to solve for this. rather than the old mindset of a one-man show behind the entire GP or something.
Aziz.
It's the largest, the most important challenge to solve for the industry. In the end, you
Not in the KSA alone, or
no, I think it's
globally
global.
as
I
well?
mean, we're London-based and we have that same problem as well. I think it is a challenge because you operate in an industry where your assets leave the building at the end of every day. So the only thing you have, the only thing you can invest in is talent. And you don't want to get someone who's a little bit better than someone else. You want to always try to get the best. That's the only advantage you have.
But the two issues you I think all put on the agenda when we were talking earlier was retention and compensation. Very pragmatic, very prosaic, but vital. Otherwise, you're not going to keep people.
Yeah.
To some degree, I think there's an element of making the job itself very interesting for people. I think if you only, as an emerging manager, as a small manager, back to what Sohaib was saying, if you try to compete with other firms purely on monetary metrics, you're going to fail. They have more resources. How can you create a place where people who want to solve puzzles, who want to have who are intellectually curious, who want to have freedom to think and explore, come to this organization, and they're willing to not be paid the highest absolute amount in the industry?
You raised a particular point, very simple but very fundamental. Can we deliver value?
I mean, it's back to performance. It's very hard. One of the biggest obstacles day one for any emerging manager is having a realistic, a credible track record. So you need to survive. And emerging managers are often motivated to take additional risk to pull up the outperformance early years. Because as you know, most allocators would require 2 to 3 years to allocate of daily performance to kick off the underwriting process. So it's all about survival. You can absolutely create value in many ways, but you need to manage risk. Risk is about sizing. Make sure you have the right size in the beginning. Once you escape velocity or pass through your runway, 3 years later, cap raise and everything else will become much easier to achieve.
But you're being that brutal. It is about survival.
It is absolutely.
Fadi?
Well, maybe just commenting, I think on the maybe kind of retaining people is very important and for surviving. But I think we don't want to ignore the fact that, from my experience at least, most of the boutiques, I like to call them boutiques, you see a lot of people stay there because of the passion. And I always say, if investment is not your passion, it's only a job, you're not going to do very well. And most of the guys that actually work in boutiques usually have this passion. And what drives people is like similar passion or similar kind of philosophy of investing. And when it comes, of course, there's significant upside if it works out, because most of these structures are meant around partnership or ownership. So yet they might be not the best payers maybe in terms of the compensation, but I think that the upside, the long-term vision, and this is something a lot of capital allocators look. That's why we see a lot of the major capital allocators look. We like boutiques. Why they like boutiques? Because there's sticky teams. There's belief in the philosophy. There's stickiness to the process. That's, I think, the fundamental issue. And I think that's, also a formula for success if it's really kind of capitalized on. If you want to take on the big asset managers, you can. You have the confidence, you have the backers, you can do that. But I think the right approach, or what would attract people, the capital allocators, is uniqueness, kind of focusing on niches, clarity of process and philosophy.
Mohammed, what about the volatility of the market?
Yeah, I think that's in asset management. I think size could hinder performance in general. So I think before going to volatility, I would like to highlight one fact. If you look at the market today, our local market, around 60% of the companies have a market cap of $1 billion or lower. And that really, to me, this is a great opportunity, because these are historically have been witnessing this, that these companies mostly they lived for several decades, and they're well established. I mean, companies that are publicly listed, and they really graduate to be large cap. So the growth really lies in this area. So I think it's important it's an opportunity for an emerging manager really to be able to take advantage of market volatility during, and exploit these opportunities during high market volatility. But the investors have to be also ready to understand the behavior of these companies.
Are they ready?
I believe for a company with the right talent, the right research, the right process and philosophy would be ready really to exploit these opportunities. And back to the point, also was discussed earlier by the panelists, size is very important and could help small emerging managers to be agile in these market circumstances. So I think it's important for a long-term driven manager and to be agile and to exploit and navigate volatility for the benefit of their clients.
Aziz.
There's a local game in Saudi called Karam. If you want to beat Roger Federer, don't go and challenge him to a game of tennis. Go and challenge him to a game of Karam. You need to play a different game than the big guys if you want to win and have an advantage. You need to find your niche in order to advance. Don't play the same game. Play a different one.
Did Roger Federer accept the challenge?
Well, the challenge, if he's around, I don't know.
Do you just want to explain what the game is for those who are not familiar with the KSA?
So it's kind of like, I don't know, similar-ish to checkers, but instead of moving the parts, you kind of click them with your finger. It's a bit different, but essentially it's similar to, it's a bit of pool slash, like billiards slash, I guess, checkers.
Volatility.
Take advantage of it, come up with a strategy or modify your strategy to improve your outperformance or minimize drawdown. Otherwise, it's a problem. But I think it's an opportunity in our market, given the low number of low-vol products, long-short products, or just non-beta.
Is the agility, though, we've heard about, is that hardwired into the thinking here in the KSA?
That's the hope.
That's not the
No,
question.
we're all
though.
trying to. You never know, because markets will always surprise you. People are trying, are putting their best, but then COVID was a shock that many funds blew up, and they were very well prepared from a risk management, were agile, were resilient, but it's a new, unexpected external shock. And I think that's the humbling part of risk management and investing.
Fadi, volatility, agility.
Yeah, volatility is the name of the game, and I'm not sure what to say about that. But I think I just want to make sure I just address the point of strategies, because you asked me about that. I didn't have the chance to come to, maybe as a capital allocator, and a lot of asset managers are sitting in the room. I think it's important to guide them or give them a hint what we would be looking for from other managers, whether small or big. I
Well,
think
you give them a guidance. Okay?
we're going to give them a hint. I'm not saying a guidance.
No, you can be more open. You're among friends here.
Yes,
So
I
you
think,
can
yeah.
give them guidance, not just a
course.
hint.
No, I think what we would be looking for, and I think where there's a lot of gaps in terms of offerings in the market, I think talking about volatility, managed volatility, for instance, especially on the downside. I think we're talking about taking advantage of volatility. How about taking advantage of lower volatility? How about structuring things that have lower volatility, maybe with similar kind of, I would say, mid-size kind of risk? We don't have these products. We don't have a lot of, we're promoting and pushing a lot of like constructive activist strategies. You can have value that is above the benchmark, but you can unlock significant value from idle capital in companies and capital that is not misused. There's significant opportunities for people to take advantage of these kind of activist strategies. Talk about market neutral strategies. Talk about sector neutral strategies. There's abundance of opportunities, and I'm saying here that we are open. We're open to seed them. We're open to work with you guys to actually do something to enhance the kind of value that can be unlocked from these markets. So I think that's what we need to talk about, at least. And that's maybe the essence of emerging managers, or this, maybe they have the flexibility. They don't have 60 committees. They have to report a product committee, a marketing committee, and until they actually approve a product, maybe Abdulaziz or Sahib can say, you know what, I'm going to do this product. I'm going to call the guys at PIF or other. What do you think about that? They have this flexibility. They need to take advantage of that.
Do you think you've given them enough guidance?
You can ask them. I think we do. I think we're very transparent, and we're becoming more and more transparent. And everything we've been saying from the first panel, from Abdulmajid's speech, come to us. Don't be just brainstorm with us, and we will be very open with you.
They're really great. To be honest.
We're talking about navigating growth, and I don't really want to raise this, but I have to raise it. The geopolitics we're all facing. Let's not get into the detail, but I've been running a project for 10 years called Thinking the Unthinkable, Thinking the Unpalatable. How much is that factored into thinking, both strategic and tactical, when it comes to investment in this region?
So I think that's part of the nature of the region, and we've been through this volatility for.
Is that discounted, do you think?
I think yes. I think it is discounted because this is not something new and emerged recently. I think we are very confident about the region, about the country, and about the region, and that gives the capital commitment.
But shocks can happen.
Definitely, and I think
that's what risk and resilience is about.
Mm-hmm. And I believe these are the opportunities that we talked about, the volatility that's already embedded in the valuation and the historical cycles that we've seen since the.
Aziz.
I agree with Mohammed. I think, and just something that Suhaib said earlier, survival is the most important thing. You have to think not just as a firm, but also as a strategy. It is, in order to achieve the long term, you have to survive the short term. And so you have to think about, and really, really think, study history, but also think about what else could happen that has not happened. And if it does happen, play out these scenarios. How is it going to impact a company, a country? How am I survive? Don't take a risk where there's a 1 in 1,000 chance that you blow up, because you know what? Every now and then that 1 in 1,000 chance happens.
So is survival an alpha?
Absolutely. I think it's one of the most underestimated source of long-term alpha over a lifetime. Anything multiplied by a zero is a zero. It's not enough to do well for 20 years and then blow up.
Suhaib, do you agree, given that you put survival on the agenda?
Yes, I agree, and I would add that in our markets, I think understanding the microstructure of the market, the nature of the ownership, foreign owners, locals, institutions, retail, can give you a lot of guidance on the expected behavior if there were to be a geopolitical shock. If something is overly crowded by foreigners, their response function to geopolitical shocks is very different than local institutions or local retail investors.
Do you agree that the geopolitics and the uncertainties, the unthinkables, the unpalatables, have largely been discounted, even though, and we're not going to speculate here, they could be quite severe?
Even if though we always like to hedge for the unexpected. That's just a rule of thumb in our DNA. Always hedge for the unexpected.
Fadi.
Well, we rely on a lot of smart people to help us manage the risks, so we'll leave it up to them to manage all the risks, including the political risk, of course.
But you can give people guidance or a hint.
Well, I don't think we can. I think but we look, the region is actually, we always say the region, there's a lot of risks inherited in the region for a long time, not only now. And I'm sure a lot of managers will be able to structure portfolios to handle different kind of risks to achieve the required return. But
let me give you,
as I said, we rely on our managers to be able to manage the risks, including geopolitical risks.
Let me give you 30 seconds each for one big idea which maybe you haven't mentioned yet. I don't know what it is, about how to survive and navigate growth. Because you've put survival on the agenda, but the issue we've been discussing is navigation of growth. Suhaib.
Survival, market neutral strategies, I think they have a huge potential in the Saudi market. You're always short, you're always long, so hopefully you're eliminating the market risk, geopolitical risk.
Mohammed.
I think exploit the new markets, and new financial markets and new instruments. There is a lot of development that's happening in the country when it comes to CMA and Tadawul. And I think, for example, less than a year ago, futures, derivatives, security lending, all have been introduced lately. I think these are areas of alpha that asset managers can really capitalize on these parts of the market.
Aziz.
I think there are many ways to skin a cat. When you want to pick an investment strategy, you need to pick one that fits with your temperament and your personality, because there will be tough times. And if that fit is not there, if it's not authentically in your DNA as an individual, you're going to fail.
You've got to expect tough times.
Absolutely.
Do you think most people do?
No.
That's an important no, because actually management is about understanding negatives as well as positives.
Both as a manager and as a portfolio manager, the market has a way of humbling you over time.
Fadi, last thought.
No, I think just maybe to reiterate the point that the idea is emerging managers, boutique-led managers are very important part of the supply chain in developing the liquidity, developing the whole market. And we are aware of that, and we are in support of that. And I just want to reiterate the message: come to us, speak to us, don't be afraid of your size. We are willing to, we are flexible enough, and I would say creative enough to look at opportunities and support them.
Fadi, thank you very much indeed. Thank you to all of you, and thank you to all of you for being here. For the last 2 hours, those of you who've been here for that long, we've been creating the building blocks, which will now be capped with a presentation and a signing ceremony. So thank you very much for your attention.